Hi there. Welcome to episode 2 of Sea Lawyer Station. My name is Jose Mallari. I will be joined today by Mark Goldman. He is a subject matter expert on real estate loan and mortgage. You may be thinking, are you too young or too old for this topic? Or you are either at the beginning of your career or already retired. Guess what? Regardless of your situation, you may learn a strategy from this episode and use it to your advantage or share it with family and friends. So, stay tuned. With me today is Mark Goldman. He's a licensed real estate broker.
I am a licensed broker in California.
And a mortgage loan.
And I'm a mortgage loan officer in California and Arizona.
In both states.
Yes.
I met him, could you believe it? That was like 2 decades ago.
I would think at least that.
Yeah.
But you look the same.
Oh, thank you. You look better though. So, anyway, the reason I remember that because when I was getting ready for this podcast for you episode, I looked at the book. He was my instructor at a certain university, prestigious university, and he prescribed the book. Luckily, in that textbook, I wrote fall 2003.
Oh my goodness.
Yeah. So we met because I just got my real estate license in 2003 in the summer. And then I noticed a lot of the questions of the people I talked to, they always have a question about loans, more real estate loans and mortgage. And I said, I can't answer those questions without learning about it. So I signed up and then attended the class, and that's where I met you.
Wow. So that must have been UCSD
Yes.
back in those days.
Yes.
And then I went on to teach at San Diego State University for 13 years. I used to teach the final course that real estate majors would take for real estate investment analysis that would tie in all of their other real estate work. And I've been a loan officer here in San Diego for 33 years. I do some expert witness work to support attorneys. So I keep myself busy.
Good. So what led you to teaching?
I had been a real estate educational consultant to the National Association of Realtors in their Certified Commercial Investment Member Education Program 50 years ago.
Wow.
And that occurred because my college mentor hired me to help him write a course, and it just grew from there. So I learned to write textbooks, and I learned to create educational materials focused on real estate investment analysis. And a friend of mine that I used to do some consulting with here in town asked me to come in and speak at his class at UCSD Extension. And I said, well, I'd like my own course. I went in to speak, but I said, it'd be fun to have my own course. He said, why? And I said, well, I'd like to get the discounts on software. And the next day, the phone rang from UCSD, and they hired me, and I taught there for, I don't even remember, but many years in their extension program. And I never once bought software while I was working there. But as a result of that job, someone who I don't even remember who it was recommended me for an opening as an instructor at San Diego State University. And I did buy software while I was there. But I taught there for 13 years, and it was a lot of fun.
Oh, good. Yeah. So that's where I met Mark. And then in the process, while he was teaching, I just had that feeling. Well, first of all, I noticed he's very competent. He knows what he's talking about. And then, but one thing I was looking for was a loan officer who has integrity. And I don't know, I had that feeling while he was teaching. This guy is an honest guy. So after the course, I applied to work under him. So I worked for him as a loan officer for a few years. And then when I got busy with the kids, I just quit that and then just focused on real estate. So for people who don't who may not be aware, when you buy a house, you're actually buying, or you need to consider two products. There are two products in a real estate transaction. One is the house, and the other one is the real estate loan or mortgage. Although there are buyers who have cash, and that's very rare that people have cash to buy a house, or to pay for a house in cash, or even those with cash, they don't want to use their cash to buy a house because, like they say, cash is king. So why leave your money in a house when you can use it for other businesses and let it grow, right? So in the process of buying a house, most buyers, home buyers, need to shop two things. You're shopping for a house, and that's where the realtor or real estate agent like me can help you. And you need to shop for a loan, and that's where Mark steps in as a mortgage broker, mortgage loan officer. Now, in the process of, in my many years of, like I said, since 2003, I've been licensed. I've come across various prospective buyers and sellers. And the most common question one of the most common questions I come across is, should I buy a house or should I continue renting? If someone asks you, Mark, that question, what would you tell that person?
I would tell them what I always say to the first person who asks such a question in my class for the semester: it depends. Okay. And then whenever I point at that person for the rest of the semester, it doesn't matter what the question is, the answer is it depends. What does it depend on? It depends on your income expectations. Mm-hmm. It depends on how long you anticipate that you would own that property. And there's a difference between how long you would own the property versus how long you would live in the property. And the difference is, would you buy a starter home that might make a good rental in the future? So maybe you purchase your first home with an eye on how would that be as a rental property in the future, and then move on to another property in the future and accumulate some properties over the years. So what's your plan? What are your expectations for your income? What's your comfort level? A lot of people are not comfortable to be a landlord. A lot of people are not comfortable to be a homeowner. My son, when he bought his first home, he says, Dad, he says, I don't own a home, it owns me. There's a lot of maintenance and little items that require attention and care all the time. So it's not for everybody, but it is a way to secure where you're going to live and get a good control over the cost of how much your housing will be. The benefits of ownership, taxes notwithstanding, your landlord, you don't have a landlord, so your landlord's not going to be raising your rent or telling you you need to move out because they want to sell the property, or telling you you need to move out because they want their own children to come and live in that property. So it gives you more command over your housing. Certainly there's a great financial opportunity if you own a property long enough. It's very, very likely going to go up in value, in addition to providing shelter for you and your family. So should you buy a house? It depends.
Fair enough. So in other words, also, the product you're going to recommend will depend on that person's priority or plans, right?
So yeah, let me just, for your listeners, when we say product, we're talking, in my world, it's loan programs.
Right.
We're talking about maybe a fixed 30-year loan, maybe we're talking about an FHA fixed 30-year loan, or an FHA loan that has an adjustable rate, or loans that are payable interest only. There's many kinds of loan programs, and we call them products. Mm-hmm. And so, yeah, we do our best to match the borrower's situation with the loan product. It also depends on market conditions. Recently, in recent years, fixed rate 30-year mortgages have actually had a lower interest rate cost than adjustable rates. Years ago, that was not the case.
Right.
So then we anticipate, we look at different factors and in addition to market conditions.
Okay, good. Now, for example, the prospective home buyer went home, they talked, the couple talked, and then, yeah, let's go for it. Let's buy a house. Now, they walk around the neighborhood, they see an open house, they knock on the door. The listing agent, the agent for the seller is called the listing agent, shows them around, then finally said, you like the house? Yeah. And then his next question is gonna be, are you pre-qualified or pre-approved? So how do we distinguish between those two?
Everybody has a slightly different definition. I'll use my definition.
Okay.
So somebody who's pre-approved
Okay.
means they'll call me up, a loan officer, they'll call a loan officer.
Right.
And the loan officer will ask questions about their income, their debt obligations, are they aware of any credit issues, how much down payment do they have to work with, and what their plans are in terms of down payment, how long they would live in the house and so forth. And then based on the information during that conversation, they'll I would come up with, say, okay, you can afford this much house. And I can write a pre-qual letter which says I've talked to these people and based on what they told me, they would qualify for a purchase price of XYZ. Now, a pre-approval is a different matter. A pre-approval is after the conversation, I would request documentation of savings, income, maybe look at tax returns. If they're self-employed, maybe we want to look at the bank deposits, because you can qualify in bank deposits if you're self-employed. We would run a credit report with permission, and we would get a automated underwriting approval for the purchase of a home. At that point, you're pre-approved in my world. So I can write a letter to the agent that says, we're processing a loan application, which is true because I would have an application. We're processing it, we have credit report, we have documentation to tell us about their income and their money to close. And based on what we have so far, we have a loan approval, but now the property has to qualify. So after they get into escrow, as far as the loan's concerned, we would need an appraisal, we would need a title report, possibly other things, depending, condominium association certification if it's a condo, and if everything's okay there, so the borrower is okay, the property's okay, we can close the loan.
I hear some real estate agents or realtors say, when they after they ask that question, pre-approval or pre-qualified, they say, call your lender. Does that mean you're a lender, or is someone else a lender, the real funding source?
Good question. I'm going to change your question a little bit because it's a really important question. And I'm going to change it to the question, where can you get a loan?
Okay.
Is that fair?
Yeah.
And so, where can you get a loan? Some, you can go to your bank or your credit union, all right? But are they the lender? Some lenders, usually credit unions broker most credit unions, not all, most credit unions, especially smaller ones, broker their loans through mortgage brokerage companies. Some banks, for example, Bank of America or Chase, they usually fund loans in their name, so they are the lender that the day they close the loan. But most of the loans that they close, especially what we call conventional loans, they will actually sell into a mortgage pool. Many people have heard of Fannie Mae, Freddie Mac, Ginnie Mae. These are secondary mortgage markets where banks sell their loans. In the case of the larger banks, they typically sell those loans in a matter of hours. And that's why a lot of people get surprised. They think they did their loan with Bank of America. And Bank of America may retain the servicing. So every month you're going to send your monthly mortgage payment, but they're no longer the actual lender. Somebody bought that loan. And so you can go to a direct lender that will fund in their own name. Depending on the kind of loan program, typically they're not going to keep that loan. They're underwriting, they're making the determination whether or not they can fund the loan based on the requirements of whoever they plan to sell the loan to. Lenders who keep their own loans are called portfolio lenders because they keep those loans in their portfolios. And conventional loans typically are sold into the mortgage pools. So you can go to a direct lender who's going to underwrite in-house and fund in their own name. You can go to a broker. I'm a broker. I like being a broker. I could work at a bank, but a broker deals with many different mortgage banking operations. And so it gives me the flexibility to take my borrowers to different lenders who may specialize in different kinds of borrowers. For example, some borrowers specialize in government loans, so loans to veterans or people who are purchasing using FHA loans, which is a government insured loan, low down payment. Other lenders specialize maybe in jumbo loans, loans that are higher than what we call the conforming loan limits. The conventional loans that are sold to Fannie Mae and Freddie Mac, almost all the mortgage bankers offer them. So the good thing about that is competition, because what does competition give us? Better pricing, and it gives us better service. Because a big part of, at the end of the day, rate is very important, but so is service, because that's going to set how long it takes to close a loan. That's going to set the frustration levels. Some people get frustrated, when the loan's not going smoothly, and so service is important to me when I deliver a loan to a customer. So there's direct lenders. It might be called Mark's Mortgage Company or something like that. There are brokerages, and there are banks. And those typically are the places where consumers can go and get home financing.
Okay. For example, those couple, you gave them a pre-qualification letter.
Yeah.
And so they said, yeah, let's go for it. Let's put an offer on the house, or let's look for more houses, look at more houses. But then again, at night, the wife says, wait, I know we got referred to Mark because he has a good reputation. But then she said, but we've been banking with Bank of America for 20 years. And we had no issues at all with Bank of America. We go to their website, we can see their rates. They're transparent. And then they're a big bank. And the account executive that we spoke with, they're very friendly and helpful. So why should we choose Mark over Bank of America?
I don't want to disparage Bank of America.
Okay.
So if they have a good relationship, I probably would not have spoken to these people in the first place.
Okay.
Should people shop? Sure.
Okay.
Borrowers should be informed about what's going on. I always expect my borrowers, the borrowers I work with, to act in their best interest.
Okay.
You may remember I tell everybody my 3 rules.
Yeah.
Rule 1 is I expect you to act in your best interest. Rule 2, I do this all day, every day, and you don't. There are no dumb questions, and I expect you to remember nothing.
Okay.
And rule 3, I say to my borrowers, when you're looking for me, I want you to find me. Make a call if something's on your mind. So, if somebody wanted to talk, I don't want to say Bank of America. Let's say they want to talk to their bank,
Right.
or their credit union,
Right.
or certainly if they know somebody in the business, they're probably not going to reach out to me anyway. They already know someone.
Okay.
I will tell you generically, not always.
Right.
We can't promise something all of the time. Many times, most of the time, I believe that we can deliver better service and better rates than the banks. And the reason this occurs in my experience, typically the banks have central processing centers. They're operations that may not be located even in the city where you're doing the loan, and everything gets fed in there. The loan officer you're dealing with doesn't have as much control over the processing, which is the processing is okay, you're in escrow, we're gonna do a loan, we've got to collect the borrower's documentation, the property documentation, we have to order the title report, get the escrow instructions, get all the necessary paperwork reviewed by the underwriter. So we have to, the processor is the person who's going to get all of the required paperwork to the underwriter for review and approval. There are usually conditions. Processor will help to take care of that. For example, all loans, the borrowers have to have insurance in place when they close. So those things have to be coordinated. Well, in a larger organization like a big bank that's using central processing, the service tends not to be as personal, and the loan officers often don't have the control over the processing. They go into the processing queue, and somebody else is in charge of when that loan gets done. So I feel if a big part of my job, why do I still have a job instead of losing out to the internet and automation and what's coming is artificial intelligence? Mm-hmm. And I always feel a big part of my job is to keep my loan file going for my customer, from my borrower. And the borrower a lot of times doesn't see this, but when things go wrong, that's where I'm really earning my pay, you know. And a lot of times, I see when people go into a large organization, they get a call from somebody. I want to talk about credit later on, but I'll get a call several weeks later and say, hey, things aren't going too smooth with this lender. Can we do the loan with you? And that's not an uncommon thing. And sometimes I say, no, you're too far along. You're gonna have to stick it out. I don't want to, jump into the fray and make the situation worse. If I can make it better, then I try to make it better. So how do we compete with the big banks? Just like they try to compete with us, but I don't think they're as competitive. Price and service. And personal expertise.
You say pricing, like, for example, I when we worked together, and even when you worked on my loan, you see loans, you can originate loans with Bank of America, and at the same time there's loans available if I walk into Bank of America. So what's the pricing difference? What can you tell our viewers?
If most of the banks are not offering. Back in the olden days when you and I first met,
okay,
Wells Fargo, Bank of America, Chase, they had what's called third-party origination. They would broker loans,
okay,
and they were some of them had excellent programs that weren't available, especially if they're kind of program that they would hold in their own portfolio for whatever reason. For a long time, Wells Fargo and their wholesale, they were after certain minority markets to make their community lending standards numbers better. So they were a terrific place to bring some first-time home buyers and so on. And they would offer the loans at a wholesale price, and as that indicates, I could compete with their retail and still make a commission on the loan. They would offer in their third-party origination, they would offer the loan to us at a price, interest rate and points, where we could make a commission on the loan that would be competitive with their retail. So it's not too common anymore, though.
Okay.
And if you think about it, the model doesn't work that well because they're always competing. They want to do the retail business, because they can capture more of the revenue. They can make more money if they can bring in the retail business. And so I'm not aware of any of the. I mean, there are some large banks that offer jumbo programs now nationally, and that's another thing. So they may have a lot of deposits that they can use for loans, and they might fashion some large credit unions and so forth. They do come up with their own products which can fit a certain niche in the market. It's another reason I like being a broker, because I get to offer all these products, all these loan programs. So So yeah, the short answer to your question is they used to offer them wholesale.
So when looking for a mortgage broker, or when choosing between mortgage brokers, what should the borrower look for?
Well, I always say experience, expertise.
Okay.
You know, how long you've been doing this, and what do you know about it? Because, you know, like so many other professions where sales involved, people come and go.
Mm-hmm.
You know, if there's, although the licensing now for being a loan officer raises the bar quite a bit, so we don't see as many people coming in to the lending business just because it's a hot market.
Mm-hmm.
But you know, get a referral, get you know, what questions should a consumer ask? How long have you been doing this? What's the company? Why is your company a good company that I should work with?
Mm-hmm.
You know, I mean, I have a lot of worthy competition out there.
Mm-hmm.
People I consider to be competent and good guys. A lot of times I'll get a call and they'll say, "Oh, I'm working with Jose Mallari." I'll say, "Well, he's a great guy." You know what? I've made a habit. I don't like to take business away from honest people.
Mm-hmm.
You know, but there are some people who are less competent, less experienced, less focused on the borrower's interest. You know, so I get a read for those things. Get a read. Does your loan officer know what they're doing? Does your loan officer ask questions that make you feel comfortable that they're going to look out for your best interest? You know, over the years, I've been doing this in San Diego for 33 years, and I always tell people, you know, at the end of the day, it's not as important for me to close this transaction, is that in the future, if you ever need me, you come back and you send your friends.
Mm-hmm.
Because that's what feeds my family. That's you know, what supports me. So I don't need this particular loan.
Mm-hmm.
I need the service level to be satisfied to such a point where, you know, my borrower is going to tell their friends and their family, "Hey, you got to use this guy."
Mm-hmm. That's good. Yeah.
You know, so that I've always worked on that more. The money comes
Mm-hmm.
if you take care of your
Right.
customers.
Okay. For example, the couple finally decided, yeah, let's go to Mark, make an appointment, and then they did show up in your office here, right here, and then what's gonna happen?
I'm gonna ask them what questions. Usually, what I say is, before I ask you questions, what questions do you have?
Got it.
And most of the time, people don't have any or very many questions to start with,
Mm-hmm.
but they get a lot of questions when I start asking them questions.
Oh.
So, but mostly what I need to know is how much money do you have down,
Mm-hmm.
how much money do you have coming in the door, and how much money goes out the door for debt. Because
Mhm.
that I need to be able to calculate a debt to income ratio, because
Mhm.
that determines how much a lender can lend to a homeowner.
Mm-hmm.
And then the other thing I like to get into with people is I say there's two issues. Number one, how much is a lender willing to lend to you? But the more important question is, how much are you willing to pay each month?
Mm-hmm.
What's your housing budget?
Right.
And in families, households have a very wide range of this. Some people are willing to use a big portion of their income to have a house that they like.
Mm-hmm.
Other people have lifestyle considerations. They like to travel. They like to have a boat. They want to spend time on their camping expeditions or whatever.
Mm-hmm.
And so very, very few people come to me with a budget, but I always like them to think about that.
Mm-hmm.
And you know, a lot of times people go, well, let's see, one paycheck can cover the mortgage and the other paycheck will cover everything
Mhm.
else. But not everybody feels that way. And actually, the last couple of years, I've been doing loans for children of my first customers. And this has been fun. And I just had a conversation with a young lady and her partner this week who wasn't born when I did her mom and dad's first mortgage.
Mm-hmm.
The first time I did a loan for the mom and dad.
Right.
But I told her, this is true, I remember her mom and dad's first mortgage because at the time, and this was over 30 years ago,
Mm-hmm.
we did have that conversation about being house poor,
Mhm.
meaning they went for the largest mortgage payment that they could possibly afford to get the most valuable or highest priced home that they could possibly afford. And I remember to this day having the conversation with them about that.
Mhm.
Okay, fast forward 30 plus years, they've got a couple of kids. I did a loan for the older sister a couple of years ago, who also wasn't yet born when I did it. And but now mom and dad own some rental property. They're positioned to retire. They were able to assist their older daughter with the down payment. The younger daughter saving, I think, should be okay. But the point is, there was a couple who on their first home were comfortable with maxing out how much they could afford.
Okay.
So I encourage people to think about it when they're contemplating buying a house, you know, and it's funny how many people start shopping for a house and they haven't got as far as how much down and how much a month, you know, but how much down, they usually know. They usually know how much savings they have, what family resources may be available and so forth. How much a month, it's interesting, especially first-time home buyers, how many haven't thought of that until I ask it. And I know that by the look on their face when I ask.
Right. So basically, it's like going to a grocery. You got to know how much money you want to spend, right?
What's your budget?
Yep. So that if it's about outside your budget, don't buy it. Buy within your budget.
Yep.
So for you to determine that, you mentioned some documents earlier. So basically, it's income, right? Proof of income.
Yep.
Credit check. You're gonna run their credit, and then tax returns, prior 2 years, and what else besides those?
Well, if some people have other sources of income,
Okay.
so if it's a durable source of income, we need to document. For example, they may own an interest in a rental property.
Mm-hmm.
They may have a portfolio of notes. Self-employed people, if somebody's been self-employed for 2 years, they may not have tax return income. So self-employed borrowers for conventional loan document their ability to repay. That's an important term because in the conventional loans, you have to document the borrower's ability to repay the loan.
Mm-hmm.
And with a conventional loan, they use 2 years tax returns.
Mm-hmm.
But a lot of self-employed people have really good accountants.
Mm-hmm.
And to minimize tax obligation, as a self-employed person, they may be able to expense a lot of their business costs.
Yeah.
And they may be able to afford more of a payment than their tax returns reflect. So there's a whole group of loans for self-employed borrowers where the self-employed can qualify with alternative income documentation. The most common is for a self-employed person to use 12 or 24 months of bank statements,
Mm-hmm.
either business bank statements or personal bank statements. And the rates on those are a little bit higher, but you know, it's funny, a lot of times starting in October, I start getting calls, how much taxable income do I need to qualify for this loan? And when we go over the numbers, if they don't change the way they expense their operating costs, they may be better off to pay a slightly higher interest rate and have a much lower tax bill.
How about tax-free loan? Tax-free income like veterans disability pay.
Good question. Disability and housing allowance,
Mm-hmm.
those incomes, we document how much they are, and they get what's called grossed up.
Okay.
So the underwriter treats that, they get grossed up because no income tax on it.
Mm-hmm.
So depending on the loan program, the underwriter can add on an additional 20 to 25% of the non-taxable income portion.
Mm-hmm.
You know, another income source we see, restricted stock units, RSUs. And so then, is there a history of that? Is there a likelihood it will continue? Have the restricted stock units vested? Have you been taking advantage of it, and so forth? But so you know, there's all there's one of the fun things about this job is you know, you see the myriad ways that people make a living.
Yeah. So I think, if I remember correctly, you use all those income items to calculate a borrower's debt to income ratio.
Yes.
And that determines is there a maximum debt to income ratio?
Yes. For most loans.
Okay.
Believe it or not, for VA loans there isn't.
Oh.
But first of all, let's define debt to income ratio.
Okay.
Debt to income ratio is the total monthly debt obligations that a borrower has. That would be minimum credit card payments, student loan payments, car payments, child support or spousal support if somebody's divorced. So any obligations that the borrower has. Now, the obligations may not count if, depending on the loan program, there are less than 10 or 6 payments depending on it. So in other words, if your car loan's almost paid off, and let's say you've got 6 months remaining, then that payment may not be included as part of your total debt. All right, so we look at the total debt obligations, and then we look at your gross income before tax. And that includes the grossing up. Another income that is not taxable is in-home health services. So people who assist a family member and get paid for it to help people stay at home, that's non-taxable income. So we have to document how much you get, but you get to gross that up. So we look at all the sources of income that we can identify, and we take the monthly debt obligation, including the cost to own the home each month. So we talk about PITI, which the short version of that is principal and interest, the loan payment, property taxes, and insurance. But it would also include mortgage insurance if that's part of it, homeowner association, and other assessments on the property, divided by their gross income. And depending on the program, that's going to be somewhere, the limits tend to be, it depends on the program, somewhere between 43 and 50%. So if somebody's making $10,000 a month, their total debt, including their house payment, could be maybe $5,000 a month, half of that.
You mentioned mortgage insurance. Is that protection for the borrower in case they become delinquent?
Thank you for asking in that way, because it sure is not. Mortgage insurance protects the lender from default. It does not protect the borrower from anything. It's not life insurance, it's not lose your job insurance. It protects the lender in the event that there is a foreclosure. It ensures the loss that the lender could incur upon the sale of the property. So why should somebody pay to insure the lender?
Right.
Short answer is so they get the loan.
Okay.
You know, when's it required? Typically when there's a down payment of less than 20% of the purchase price. Because if a borrower makes 20% down payment, the lender has some protective equity. The borrower's got some skin in the game, and if there's a market fluctuation, it's very likely the borrower would be able to sell the property and repay the lender in full. But if they put down less than 20%, then on a conventional loan, mortgage insurance is required. So the lender would require that either the borrower purchases mortgage insurance. There are several ways to do it. There are some loans that are called self-insured, where basically the lender gets mortgage insurance and they add it on to the cost of the loan. Borrowers can pay for it each month, and they can also pay a single premium, or there are programs where you could do a split premium. So there's all kinds of things you can talk to your loan officer about how to do the mortgage insurance.
What is the lowest down payment that's allowable right now?
If you're a veteran, 0.
Okay.
So you can buy a house with nothing down if you qualify for Veteran Administration benefits. There are some 0 and 1% down programs out there with down payment assistance available. It's not too common, and most of those programs require that the borrower be within certain income limitations. And here in San Diego, we don't see much of it, to be honest with you, because the income limitations are less than what it would cost to own a home in San Diego, typically. But that is something you can ask your loan officer about.
Okay. Is there an existing first-time home buyer program?
They come and they go.
Okay.
And you know, I'm glad you brought that up, because first-time home buyer programs typically are not reductions in interest rates. Typically, first-time home buyer programs have waivers of other requirements, maybe lower reserves required. What are reserves? Reserves are savings that a borrower may be required to have after they close on their house. So they may be waived or reduced with first-time home buyer. First-time home buyer programs might allow higher debt-to-income ratios. And there are, for certain classes of employees from time to time, and depending on location, we don't see too many doctor programs here in California, but some states offer special programs for doctors who are purchasing a home. So there are programs. It depends where you live. Some of them are local, some of them by state. Some of them are federal, although those are pretty rare. But for example, federal, they used to do something called a mortgage credit certificate. And you would get a credit on your taxes, not a reduction, but an actual dollar for dollar credit on your taxes. And they would reduce your house payment by that amount and qualify you on that lower house payment.
Okay.
So there are different things.
Good. Good thing you mentioned. Now that you mentioned where you live, where the buyer lives, I know in the Philippines there's restriction in buying real estate. I think there's a citizenship requirement, but I don't think there's one in the United States. I'm not aware of any citizenship requirement. But then, what's the difference? Is there a difference in when a person who lives in a foreign country wants to buy a house here in the U.S. as compared to someone who's actually living in the U.S.?
Good question. And the answer is yes. And I say it a little bit hesitantly. There are different rules depending on the status of the buyer.
Mm-hmm.
So, for example, there might be a private party lender out there who doesn't really care about the citizenship or the residency.
Mm-hmm.
Somebody puts down a big down payment and makes a high interest payment. They're using it for a business property. But if somebody is in the U.S. legally, if they're working here on a H-1B visa, for example, and these rules may change because immigration's kind of it's an issue. Things are changing very quickly.
Yeah.
But up to now, if somebody was here legally and they had banking relationship and they had banking history and they had U.S. credit history. So if they had a couple of credit cards for a year or so, they have a bank account that's been open, and they can show a visa, valid visa to be here, or of course a green card. Then if their green card is treated just like a citizen. If there are other lenders that will do a loan if somebody can get a verified Social Security, a tax identification number. So yes, they can buy, but it depends on their residency status. Another issue can be, where does the income come from? It's difficult to qualify somebody. Here in San Diego, we're a border city. If we have somebody who is living here, but they work in, say, Tijuana, our sister city across the border, it can become pretty cumbersome. First of all, the documents for income all have to be in English. You know, so if somebody has a foreign income, it can become pretty difficult.
Are the rates the same for a foreign buyer
It
and a resident?
depends.
Oh, okay.
Typically, if they have legal status, like a green card,
Okay.
they can get a conventional loan, which is same rates
Right.
as everybody else. But once you start getting into the, they're not sure they're going to be here, where's the income coming from,
Right.
then you're looking at different kinds of loans. The cheapest loan, when I say cheapest and price, that in my world, that's referring to interest rate. So the lowest effective cost to the borrower. The way I would say the lowest effective cost to the borrower would be the lowest price.
Okay.
All right. And so, you know, the lowest price loans, the lowest cost, the lowest interest rates tend to be the conventional loans, the loans that get sold into the Fannie Mae and Freddie Mac pools of mortgages. So, you know, if somebody can qualify for one of those loans based on the property, the borrower, and the income, then that's probably going to be the lowest cost loan for that borrower.
You mentioned effective rate. Is effective rate the same as APR?
It is for the full term of the loan.
Okay.
All right. So sometimes we're interested to know, for example, should you pay points?
Right.
So we might look at the effective borrowing cost with the assumption that somebody's going to pay the loan off in 3 years, 5 years, 7 years, whatever. You know, now the effect there. If you get a loan and the interest rate of the loan is, let's say, 6%, all right. If there are no closing costs, no charges to obtain that credit, the annual percentage rate, the APR, which is reported for all credit in the United States, credit cards, car loans, everything, would be the APR, the annual percentage rate, the effective cost to borrow would be 6%. But a lot of times people hear the term points. What are points? 1 point is 1% of the loan amount. So if you have a loan of $100,000, 1% of $100,000 is $1,000. Well, if you pay $1,000 at origination to get a lower rate, you only get $99,000 net after you pay the $1,000 point. And so now the effective cost to borrower is higher than that 6%, because you're paying 6% on the $100,000, but you only got $99,000. So APR is a calculation to determine the effective interest rate if the loan were held to maturity. So, for example, a 30-year loan, then you take they're called prepaid finance charges, away from the loan balance, and determine what the interest rate would be on that remaining balance given the payment you're going to pay on the full loan amount at the nominal rate, in this case 6%. So the effective rate is going to be, to me, the effective rate is, as I said earlier, sometimes we look at the loan and say, well, you know, I'm only going to own that house for 5 years. Maybe you got somebody who's in the service, and they know they're going to be stationed here in San Diego for 3 or 4 years.
Right.
So we might look, is it worth their while to pay points to buy down the interest rate if they're only going to be in the house 3 or 4 years? You know, so then we might, you know, take a look at it.
And you mentioned origination. Is that the same as your commission as mortgage broker?
Yes. Well, the origination fees are part of the mortgage broker fee. Typically, the mortgage broker is paid by the lender.
Okay.
All right, and we contract every quarter, our company, and it's the way it is for everybody. If we go to Mallari Mortgage, you know, you're going to pay a certain commission on loans. If we go to Goldman Mortgage, you know, we might offer a lower commission, but that lets us offer lower rates to your customers. So, but the origination fees include the mortgage broker fee, they include the underwriting, processing fees, the credit report, the appraisal, and fees that the lenders charge to close a transaction.
Okay. In case some of our viewers would like to contact you, what's an easy way to contact you?
All my contact information is on my website, which is my name, markgoldman.com.
markgoldman.com.
Yep,
Okay.
so my phone number is on there, my email's on there, but my email is loan guy, Loan, loan like to lend money, loan guy at markgoldman.com.
Good.
And my cell is 619-840-7108.
Thank you for that. And by the way, if you need help on real estate, on the housing side, feel free to get in touch with me. You can call my brokerage. It's Realty Source Inc. Just call them and then ask for me, Jose Mallari. They should be able to connect you to me. Thank you.
And Jose will connect you with me.
Yes, exactly. I will.
Or can connect me. I mean,
okay.
You know.
Yeah, that's right. Okay, now, I remember in class you mentioned there's always a seat for every behind. What does that mean?
There's a seat for every behind means there's a loan program for every borrower. There's a house for every home.
No matter how bad their credit
Yes,
is.
exactly. It's going to be more expensive. It's going to require a larger down payment. But and the art of the deal for a mortgage broker is to get the least expensive loan, the lowest interest cost loan for a borrower. But if somebody is, I'm surprised you remember that.
I learned from you.
But yeah, there's always some deal for someone out there if they're willing to pay the price and cooperate with the required terms.
Okay.
And usually that's a function of larger down payment plus higher interest costs. But depends on your situation. It may not be as bad as you think.
Right. Good. Okay, now we've been talking about down payment. Now, closing costs, is that the same as cash to close?
That's part of the cash to close. So how much cash do you need to buy a house?
Right.
So if you're buying cash, you would need the purchase price plus what other closing costs you may have when you acquire the house. You're gonna have title and escrow, you're gonna have recording fees to the county clerk. You're probably gonna get some insurance on the house if you pay cash. If you get a loan, you're required to have insurance on the house. If you get a loan, in addition to title, escrow, recording, insurance, you're also going to have lender fees. You're going to have possibly discount points to buy a lower interest rate. You might have a credit for accepting a higher interest rate, but you're going to have underwriting fees, processing credit, appraisal, flood certification. Usually the escrow company is going to have fees for a notary to have you sign your loan documents and getting the mortgage documents back to the lender and so forth. So there's going to be fees for that. So how much money do you need to close? You need the purchase price less the loan amount. So that's your down payment.
Okay.
All right. And so down payment only includes the amount of cash the borrower is putting toward the purchase of the house. Plus, you need your closing costs, and sometimes the seller might give you a credit, so that's reduces closing costs, and also so that would be the total cash to close. And then I would add some loans, depending on what you're purchasing, require that the borrowers still have savings after they close. And the lender would call that reserves. Now, typically for somebody buying a home for themselves with good credit, it's not required. But some jumbo programs require it. Some loan programs require it when a borrower owns more than one property. For example, if you're purchasing a rental property, the programs all have slightly different requirements, but they might require that you have, say, 3 months of 3 times the monthly mortgage payments, or 3 times the monthly principal, interest, taxes, and insurance payments in the bank after you close. Now, you don't move that money but you have to document that you have it.
Okay.
So cash to close would be the down payment plus the net closing costs.
Are any of the items in the closing cost negotiable?
Well, I guess, yes, the short answer is yes, but it's kind of hard to do it. For example, the title and escrow fees, very few consumers get involved with negotiating, title and escrow fees, or typically the real estate agent is going to specify what title company.
Okay.
They're going to suggest
It's
to the buyer and the seller which title and escrow to use, and that may so typically they don't shop for that. There's nothing much that can be done for it's a tough question, because technically yes, but most of the stuff you have, for example, the appraisal, unless you can negotiate for somebody else to pay for the appraisal,
right.
We don't even get to pick the appraiser.
Mm.
When we submit a loan, the lender picks an appraisal management company. We don't even get to pick. Usually, we don't even get to pick the appraisal management company,
Right.
and they set the price.
Mm-hmm.
So, there's not a lot of flexibility.
Got it.
And then the other thing that's happened with regard to how much we make on the loan,
Mm-hmm.
there can be some wiggle room there, but we as loan officers have to be concerned with it's called disparate treatment. In other words, I have to charge you the same amount I would charge any other customer.
Oh, okay.
And so they watch that. That's part. Every quarter we file a report that lists all of the loans that we haven't processed or that we have closed, and they watch those statistics pretty carefully.
Oh, good.
So it's everybody's got to be treated the same,
Okay.
which is fair housing.
Yeah, thank you. And for our viewers who are from outside California, you may be wondering what's close escrow, whatever. Escrow is like a third party in between the buyer and the seller. And so when we say open escrow, it's when there's a contract between the buyer and the seller, and they submit the paperwork to the escrow company, and then this escrow company opens escrow for that property, and that escrow company deals with the lender, the buyer and the seller. The escrow company makes sure all the paperwork is submitted on time and accurately. And when it's all done and it's all funded and paid, and then they say, and then the title is about to be transferred or has been transferred, then they close escrow. Am I pretty close to the explanation? Yeah.
I describe the escrow as a third party neutral to the transaction that's kind of like the traffic director.
Okay.
They don't negotiate anything.
Right.
Their job is to be sure that all the terms of the purchase agreement are met.
Right.
Which is basically the buyer gets the property and the seller gets the cash, and the lender gets a deed of trust to secure the property that gets recorded properly.
Mm-hmm.
And everybody gets paid.
Okay, good.
They pay everybody.
Okay. Now, one essential step in the borrowing or in the loan process, as you mentioned earlier, is credit check. Can you tell us more about that?
Credit, when I do first-time homebuyer programs, I find that credit's the most engaging issue. So everybody's heard of FICO scores.
Mm-hmm.
So let's back up a step and say, for mortgage, most companies require that we get 3 credit scores, 3 FICO scores, and they use the middle score of the lower scored borrower. So how do you get your scores up? What drives your credit scores? And you can get your scores online. Everybody can go. What I always recommend is go to the Federal Trade Commission. So it's ftc.gov, and on the government's Federal Trade Commission website, right on the front page, it says get your free credit report, because the free credit report is some I can never remember who it is. You can get, most of us have credit cards that give us our credit scores. By the way, those are consumer credit scores. People are always disappointed because typically consumer credit scores are higher than mortgage credit scores.
Oh.
So there's credit scoring models. When you go into the hospital, they check your credit. When you buy a car, when you apply for a credit card, or even when you don't apply for a credit card. But mortgage, we get mortgage scores. But in general, what's going to drive your credit scoring, most of it's intuitive. Pay your bills on time. So, you know, if you had a bankruptcy or a judgment, that's going to hurt your score. One thing that's not intuitive, if you were to pay off a collection account today, so you think that's good, your score should go up. Your score will actually go down because that's a recent remark on a derogatory credit remark. It'll go up over time, but if you are purchasing a home and there's, say, a medical collection account, you don't want to pay it off until the underwriter tells you to, and then you pay it off through closing. Because the underwriter also knows that it will have a negative impact on your credit score, and that could impact the pricing on your loan. By the way, they will run a credit report the day they fund the loan. It's one of the last things they do. Why? They're looking to see if you bought a car while you had your house in escrow. They're looking, do you have additional debt? But let's go back. So what makes your credit score high? Pay your bills on time. The most important thing that we can do to influence our credit is carry as low or no balance on your credit cards as possible. When people are accumulating credit card debt, it means they're living beyond their means. That's a signal that there's going to be a credit problem. And so when people carry a high balance on their credit cards compared to the total available credit, that's usually the biggest thing that will reduce credit. Another thing that will reduce credit scores is if you watch TV late at night and the guy selling the furniture or the televisions or whatever, and there are no payments for 15 years, those loans are new credit. That will bring your score down if you get new revolving, new credit cards. Because there's no payment history on a new account, so that's more risky. And why is somebody getting more debt? More credit card available debt. It's charged up because if you go buy a bed, for example, that new credit card you get might be, the limit might be the cost of the bed. So now you've got a new credit card with 100% of the credit available used on it, and there's no pay history on it. So if you get, a lot of times people are buying a house, they're going to buy furniture to put into the house. Do it after you close. And I've seen those credit for furniture loans bring down scores over 60 points, and that means you're going to get a higher interest cost, or maybe have to pay more points. So keep your credit card balances as low as you can. Don't apply for new credit when you're anticipating purchasing a home, unless it's absolutely necessary. But new credit, even installment credit, like buying a new car, can have a negative, probably will have a negative impact on your credit score. So your actual points that you pay on a loan will be influenced by your credit score.
Now, question, does either marriage or divorce affect your credit score?
It may not affect your credit score, but it can affect if you're buying a home together.
Right.
So a lot of times, it's really funny. Typically in a couple, whether they're married or not, the one making the most money typically has the lower credit score. That's been my experience. But be that as it may, there are loans where one of the borrowers, you could be a spouse, could be a partner.
Okay.
All right. But one of the borrowers may have a terrible credit score for whatever reason.
Right.
And so if the partner with the higher score qualifies on their own income,
right,
then then a lot of times we'll do the loan just with that one borrower.
Oh, okay.
But the spouse would have to also sign the deed of trust. It's called a non-borrowing spouse. So you can do it that way. One thing we don't see too much of anymore, because people wise up to it. When I started in this business and people got divorced, they would fight. And they would try to hurt each other. And one of the ways they would try to hurt each other was damage to credit. So they would maybe stop making the payments on the house, they would stop making the car payments, they would stop making the credit card payments, and everybody's score plummeted. And that's a terrible time to ruin your own credit, you know, especially if you're separating into two households, and you maybe need a new car if that's happening, or you may need to, you know, if you're going to move, there's going to be a credit check for a landlord or to purchase a home.
Right.
You know, so in recent years, last 25 years, people have kind of gotten over trashing each other's credit, you know, which is a good thing.
Yeah.
So, you know, does it matter? Spousal support and child support do count as a debt. So one of the issues can become if your children have grown, you know, when does child support end? Because the obligation won't count, you know, on a conventional loan if there's less than 10 payments remaining. But sometimes the agreements say, well, we cut it off on their 18th birthday unless they go to college. You know, so there's things like that.
If the borrower gets a copy of the credit report, right?
No,
Oh, they don't.
do not.
So how do they find out if there's an error?
Good question. And they have to get their own credit report. And actually, when we buy credit, the credit bureaus they get really angry at us if we give somebody a copy of their credit report. We're contractually bound not to do that. However, you asked a really good question. Let's say somebody applies for a loan and they have a surprisingly low score. Their scores are disclosed. So you get a piece of paper that says, here, we ran Equifax, TransUnion, and, oh my gosh, I just have a brain clog on the third one. Equifax, Experian, and TransUnion.
Yeah.
And here are your scores.
Yep.
All right. And you have to sign a paper that says, I told you what your scores were.
Yep.
All right. But, and it also gives the 4 reasons that influence your score, starting with the reason that had the most impact on your score. And this is something people don't understand, because a lot of times you get somebody with an 800 FICO score and it'll say pay history. And the person will say, well, I've never ever missed a payment on anything, ever.
Right.
The reason their score came out, whatever it is, the thing that had the most influence was their pay history. Even though they have perfect pay history, that's the thing that had the most. Then the next one down, public records. Public record would be a bankruptcy, a judgment, something like that. And, you know, again, somebody with a high credit score might go, I never had anything like that. Maybe not. You have a very, very high credit score, so it had very little influence on your score. And that was the second most weighted thing. So, yeah, different scores. Oh, so if something's going wrong, so how would you know? So, a lot of times, you know, we all do. Things happen to everybody. Right. You know, sometimes they're tragic events, health, one thing or another. Sometimes they're just, I was on vacation, whatever. You know. So we'll get a request for a letter of explanation. There's usually 2 requirements. There's regarding credit from an underwriter. There's going to be your credit report's going to have a list of everybody who's made a credit inquiry on you within a certain period of time, usually 90 days. And so the lender's going to want a list of every single one of those credit inquiries, and was there new credit? Like here's a credit inquiry from the Chevrolet dealership. Did you buy a new car? Is there a new car payment? So the new car payment might not be registered yet, but you do have an obligation. So we need to know about that. So they usually ask credit inquiry, and then a letter of explanation for credit would be requested if there's some issue on the credit report, maybe a bankruptcy, a foreclosure, maybe a collection account, maybe, okay, here's a common one. There's a medical collection account. You owe the doctor money, and they sent it to collection. So typically, everybody's situation, it is what it is, and people should always tell the truth. But a lot of times that occurs when there's a dispute with the insurance company, the health insurance company.
Okay.
So you need to, sometimes they're deal killers, sometimes they're not. Late pays, it's good to pay your bills on time. And if you don't pay your bills on time, that's going to be a problem. But I always tell people, if you look at a credit report, or we look at a credit report, somebody told me this a long time ago, that a credit report is kind of a timeline of your life. So if you see that from, I don't know, January 2022 to June 2022, this person was late on everything. But before that, all bills paid on time. After that, all the bills paid on time. When I see that, I would look at that borrower and say, what happened in January of 2022? Right. Because I know something happened. Something interfered with their ability to make their payments. And almost always there's a story. I lost my job, we were getting a divorce, I was sick. Something happened to that borrower at that time period. And then if you see somebody, I'll never forget this. This was over 30 years ago. I was sitting at the kitchen table taking an application, and I said, "Well, do you make your payments on time?" And the wife says, "Well, I always pay the late charges." By the way, I closed that loan. Okay. But anyway, when I started my first week on the job, I asked a colleague, I said, how do you know if somebody's got bad credit? And they said, oh, it's easy, ask them. If you, and I would invite your listeners to maybe consider this, if you get a long story, they probably have great credit. They, if you get a long story, like, in 2010, I was on my round the world trip, and I had made arrangements for everything to get paid, but I forgot that I had this new credit card. I didn't put them on my auto pay, and I was 3 hours late. That somebody's got excellent credit. Right. If somebody says, yeah, it's pretty good, I start asking a lot more questions. Oh, okay. Do you pay your bills on time? Right. Because back to the timeline. If you see somebody's got a late pay in January 2022 and November 2022 and March 2023, they're occurring all over the place. This is somebody's not checking their bills on time. Credit is two main issues: ability to repay and willingness to repay. Now, what a lender is really concerned about is they want your willingness to repay to be quite high. They want you to be concerned about paying your bills on time, managing your credit properly, not getting into too much debt. All right. So that's willingness. Ability, that's where things happen to us. That's where we get sick, we lose our job, we get divorced. Those are things that can impact our ability to pay on time. So when we see things on the credit report, we will ask the borrower, and we will give them the details that we have if they don't get their own credit report. Now, sometimes it might be an error, that we need documentation. No, I did make that payment. Here are the checks. But if we said, well, you had all these late pays in a small period of time, or you've had late pays all the time. What's with that? Right. And the ones with the people who are not careful to manage the credit properly, those are tough. Okay. Those are tough. It's hard to get somebody who's got like 6, 7, 8, 10 different late payment occurrences, and they're trying to come up with an excuse for every single one. the words don't match the music. And boy, I tell you, underwriters have heard it all.
Mm.
I learned so much of how people can try to defraud a lender from underwriters who ask very insightful questions.
Yeah.
Because they're trained on this.
Right.
Yeah, we are too.
Yeah.
But a good underwriter sees things that are pretty detailed.
Okay. Now, assuming a buyer, the home buyers finally bought a house, they closed, they were living happily ever after in that house, and then they suddenly get a promotion. Both spouses, both of them, husband and wife, they got a lot of income, and then they talk about, hey, should we invest in real estate? Then they don't know the answer. Then let's call Mark Goldman. Hey, Mark, should we invest in real estate?
So, you know, when I taught investment analysis at college, I used to tell my students those decisions come from two places. Now, the first response is going to be, it depends.
Okay.
Okay? But the decisions we make on everything come from our hearts and they come from our heads.
Okay.
All right. So, should I invest in real estate? It depends on what. Do you want to manage property? Do you want to have tenants? Do you want to get those calls? Would you be willing to hire a property management company? You know, how do you feel about the responsibilities that come with being a landlord?
Mm-hmm.
And if they're okay with that, because the reward, okay, so now we start thinking the numbers, all right? You know, I think that that's going to produce the best rate of return for my capital given my situation and the other alternative investments I would consider.
Mm-hmm.
You know, then we start talking numbers and say, well, you know, how much return would you expect? You know, what would be a high return that you would expect, or maybe a more pessimistic return that you expect? Is it worth your while? You know, owning property is a terrific way to accumulate wealth. It has a lot of benefits, but it's not for everybody. So should you do it? It depends. And you know, as I say, the first question is, are you aware of what you're getting into? Mm-hmm. Most of the time, almost always, you can never say always, but most of the time, especially if you're in the property long enough, it works out pretty well. Mm. Where, you know, property values go up, rents go up, so it can be quite lucrative, but nobody's giving money away for free. Mm-hmm. You know, the landlords earn it.
Okay.
And so I'm just, you know, and it can be a terrific investment, may not be for everybody.
Okay. All right. Now they're getting older. The homeowners are getting older, and then they heard about reverse mortgage. They say, I don't know about. They say it's for seniors. And so, do you know anything? No, we don't know anything about. Let's call Mark again. Mark, what's this reverse mortgage all about?
So, reverse mortgage is a loan, like any other loan. Mm-hmm. You borrow money, you pay it back. Mm-hmm. The equity in your home, equity is the difference between the value of your property less the loan balance, mm-hmm. belongs to you.
Okay.
All right. So, you're not selling your house, you're not giving your house away. The mortgage, there's two kinds of reverse mortgages. I'm going to talk mostly about the FHA insured mortgage. It's called a HECM, HECM, Home Equity Conversion Mortgage. You can get one when you're 62 years old, and the interest in the mortgage insurance, so there's FHA mortgage insurance on it that's also paid at the beginning and monthly. And the payment is added on to the mortgage balance each month. And so there's no payment required, but your loan balance is going to get bigger over time. Well, why would anybody ever do that? That sounds crazy. Mm-hmm. And the answer is, as we age, our sources of income, typically what income is available to us? So we have employment income. Well, if I'm going to retire, I don't have any more employment income. I have investment income, and I have the opportunity to use the equity in my home Now, equity typically in your home, it's nice to say, oh, I have $1 million of equity in this house, but I can't eat it. I can't spend it on travel. I can't pay for my insurance with it. So it's asleep. All right. So how do I use it? The way I actually have a reverse mortgage, and so I don't have a monthly payment, a monthly principal and interest payment. I'm still responsible for my property taxes and my insurance and so forth, but I don't have a mortgage payment, and so I don't have to take as much money out of my investments to make a mortgage payment when so I'm not drawing down on my investments as much. The other, everybody's situation is a little different.
Okay.
The amount of money that you can get depends on the value of your house, where you live, because the loan limits are different by county, and the age of the younger borrower. So if you have, a man and a woman who are the borrowers that one of them is much younger, the loan amount will be, it's called the principal limit, is determined by the younger borrower, because they're going to be there longer. Can you pay it down? Yes, you can. You want to keep making a mortgage payment? Go ahead. What if you do? You can borrow that money back again if you have an adjustable rate. So you have a line of credit built into your reverse mortgage if you have an adjustable rate. Not fixed rate, they advance all the money at the time you close, that's it. But on an adjustable rate, any unused principal limit that was available to you is a line of credit that's available to you in the future. And not only that, that limit, that loan amount that's available grows at the interest rate of your loan. So if you close on a reverse mortgage, and let's say you have $100,000 remaining available to you, and you don't use it, and just to pick a number, let's say your interest rate is 6%. Next year, if you don't use it, you would have $106,000 available to you. So, and well, what if the lender goes broke? That's what FHA insures. So, what if your house value goes down? That's what FHA insures. So, I don't know how many of your viewers would remember that back in 2006, 2007, a lot of us got letters on our home equity lines of credit. We're not advancing any more money to you. You know, usually when I get a seniors calling me for a home equity line of credit, why are they calling? They're living beyond their retirement income, you know. And the problem with a HELOC, a home equity line of credit for a retired person, is every time you make a draw on that, your monthly interest expense goes up. But worse, the lender can turn you off anytime they want, make you start repaying principal. So that's insured with a reverse mortgage. With a reverse mortgage, the lender cannot turn off your remaining available credit line, and it grows at the remaining balance grows at the interest rate of the loan.
What if the homeowners pass away?
So if you have to live in the house, so the loan comes due when you no longer live in the house. So that could be when the last borrower passes away in the house. It could be if they need to move out, maybe because they have to go to an assisted care facility, or maybe they move out, maybe they own 2 homes and they want to rent this one. Then you have to refinance the loan. But a lot of times they're hard to refinance because it depends how long you've had it, but over the years the balance builds up. So you can refinance it or sell the property. So let's say the last borrower, they've lived there their entire lives, last borrower passes away, and now the house reverts to the family. Okay? So usually these days, kids don't want the house, but every family is different, and also depends where you live. Maybe in some other markets it would be different. The kids can buy the house, the heirs. First of all, if the house is worth more than the balance of the reverse mortgage, that equity belongs to the heirs. Okay. If if the heirs wish to keep the property, they would have to refinance the balance of the reverse mortgage. If they sold the property, again, the heirs get whatever remaining equity is in the home.
Mm-hmm.
If the kids want to keep the house, this is where it can get really good. They can buy it for 95% of the appraised value at that time, because the lender is going to incur sale costs. So if the family's going to buy it, they save on the sale costs, so the family can buy it at a slightly discounted price.
Mm-hmm.
So they can, there's that opportunity to keep the property in the family if so desired.
Okay, that's good.
One other thing I would mention, you can use a reverse mortgage to purchase a home.
Oh.
So if you're, I don't know, let's say 65 years old, you can borrow about a third of the purchase price of a home, given loan limits and so forth. So, for example, if somebody's moving down, taking a smaller home, they might be able to, instead of paying cash for that next house, they might be able to afford a bigger home or a more expensive home with no monthly payment on it by using a reverse mortgage to purchase.
Wow.
So there's a lot of other parts to this.
Yep.
But I mean, the beginning of this year, stock market went down. We're almost recovered to where we were in the first of the year. But, that might have been a time to not sell off your investments at a discounted price. So if you had a reverse mortgage with a remaining line of credit, maybe you start drawing on a line of credit until your stock prices come back, and then you can take advantage of market timing and team up your reverse mortgage with your other investment planning.
Mm-hmm.
So there's a lot of research. In fact, if people write me, I'll send you the research paper on. But that reverse mortgage can actually help somebody secure their retirement by providing another source of revenue during retirement. So
Not just the.
Not just that you no longer have a mortgage payment on your house, but that you can draw on it. And you don't have to draw on it.
Right.
And like my in-laws, they're gone now, but they had a reverse mortgage, and they had a pretty comfortable retirement, except when tax time came around, the property taxes.
Mm-hmm.
So my mother-in-law used to use her line of credit to pay the property taxes twice a year.
Mm-hmm.
And other than that, they got along just fine. They did the things they wanted to do. As we age, we start slowing down. We maybe don't travel as much or participate in, maybe we don't do as much skydiving or whatever, and we start spending less money. But most Americans don't have a secure retirement.
Right.
And I'll tell you, in recent years, the calls I'm getting on reverse mortgages are, a lot of my neighbors have reverse mortgages. Why don't I have one? Is it right for me?
Right.
And is it right for everybody? No, but it's right for a lot more people than those who may think. Many people think of a reverse mortgage as a mortgage of last resort. It's I failed. If I don't pay my house off, then I failed. Well, if you've got $500 or $1 million equity in your home and you die with that, legacy is important to a lot of people. They want to leave that to their families. That's a legitimate motivation.
Yeah.
But if you're having a hard time getting by now, half of the reverse mortgages I've done were referred to me by their children. Why? Because mom and dad aren't getting by, and the kids would rather, they don't care so much about the equity in the home as their mom and dad's financial security. Plus, they don't want to be chipping in on it.
Mm.
I've got one coming in right now. I've been telling the lady for years, you should be looking at a reverse mortgage. And her daughter will inherit the house.
Mm-hmm.
Oh, no, we don't want to do that. Well, mom's in a financial pinch right now, and all of a sudden this seems like a good idea. She may not be in that pinch if she had done this. We'll do our very best to,
Yeah.
but the point is, it's a tool to use as part of your retirement plan.
Good. That's good to know. Thank you. Before we continue, if you find value from this episode, I'd like to ask you a little favor, small favor. Please hit the subscribe button. That way you can help me grow our community, and that enables me to share at no cost to you, to share valuable information which you can use to your advantage, just like whatever you learn from this episode. I will really, really appreciate it. Thank you. Now back to Mark. I think I'm gonna ask you just to give tips for our viewers. Tips for three types or three groups. First is aspiring home buyers. Second, current homeowners who are still working. And third, current homeowners already retired. Just tips.
Well, okay, first group, aspiring homeowners. Formulate a mortgage plan. It's never too soon to do that. You don't have to wait until you make an offer on a property to talk to a mortgage professional. I really enjoy speaking to young people, myself, and I'm sure any professional loan officer, to answer questions you may have. Talk about your credit, talk about your income expectations, talk about your savings, how much you would want to save up, how much do you need to save up to get into a house. And you don't have to buy something now. You could buy something, a year. My record is 10 years. I had a couple who bought a home 10 years after I started the conversation with them. And the next one after that was at a couple for 5 years. But most people, they're anticipating purchasing a home 6 months, a year, 2 years. Have a conversation. How much does it cost? What do you need to do to prepare? Evaluate your credit profile to determine, can you pay? Is it better to pay off debt than to save? Save for your down payment. And so have that conversation and get some numbers and keep updating your plan, because things are going to change. You might get married, you might get a raise, you might lose your job, you might have a child. There's all kinds of things that can influence your plans. And so, but start someplace. All right, somebody owns a home. What should they be doing?
Right.
It depends how old they are, how long they expect to live in the home. But, we're in a funny time now, because we're in a period where so many people refinanced into 2.5% and 3.5% mortgages. But they, many years ago, my first boss in this business said people always need money. People always need money. Why do they need money? They're going to make home improvements, they're going to invest, they're going to send their kids to college. People always need money. So if you need money, talk to a mortgage professional. How can you get it? I get a lot of calls for people who are doing remodeling and adding accessory dwelling units to their house. What's the best way to finance that? Somebody needs $100,000, $200,000, $500,000 because they're going to make major improvements on their home, but they've got a 3% first mortgage. Should I pay off that mortgage and refinance or not? So what we can do, get back to the effective cost to borrow, look at what a second mortgage would cost them, and what type of second mortgage could work out for them, and keep the existing first mortgage, or maybe you are better off to pay off the first mortgage. So we can help to evaluate that if you need some money. If you're over 55, you qualify for the jumbo reverse mortgage. If you're over 62, you qualify for the FHA reverse mortgage that I was speaking about earlier. So if you're contemplating a retirement plan, you may be 62 and plan to work till you're 70 or whatever, but you might be able to save more money by getting rid of your mortgage payment today. That's what I did. I got rid of my mortgage payment, let me save up more cash. And the fundamental rule there is if you can invest at a higher rate of return than the mortgage interest cost, you should do that because you're going to build up more cash. Plus, it will be liquid. So, in addition to being an established homeowner who may need money, if you're contemplating retirement, you're 65 and you're contemplating retirement someday, and maybe sooner is better than later for a lot of people. They would rather retire sooner. Get some information about a reverse mortgage. Information's free, and talk with your trusted financial advisor and learn how you might integrate a reverse mortgage as part of your strategy. I mean, here's a case. Guy called me up, lives in Rancho Penasquito, has been there for 25 years, had a home. I'm going to make these numbers up because I don't quite remember. But he owed about $350,000. His house was worth about $1.4 million, and he wanted a sailboat and a new kitchen. All right, he wanted a $25,000 sailboat, and he wanted a $70,000 kitchen. So I go over the numbers based on their age and their San Diego County and so forth, and I discovered he could pay off his mortgage and save about $2,300 a month. Get a sailboat, get the kitchen, and draw about $1,000 a month for the rest of his life.
Wow.
So that would have turned his cash flow around. Now, he didn't need the cash flow, but it would have turned his cash flow around by about $3,500 a month, which could make a significant dent in somebody's retirement needs. Plus he would have had a new sailboat.
That's cool.
And probably ate better too, because wife would have a new kitchen. If she did the cooking, I don't know if she did or he did. Maybe it wasn't because he did the cooking. I don't know, but
that was good. Thank you so much, Mark. Appreciate it. Thank you for letting me pick your brain today.
My pleasure. It's good to see you.
Yeah, I hope
come back.
Yeah, for another opportunity. When meanwhile, to our viewers, thank you so much for staying with me. I hope you enjoyed watching this episode. And you take care. See you in my next episode. Thank you. Bye-bye.